Well, good morning, everyone. Appreciate you being here. Mickey says it's 10 o'clock, so I guess it's time to get rolling. We hope to give you a general overview of the key issues impacting the U.S. and global economies. We're going to focus on the areas that will impact most of our attendees. Well, let's review a year of continued growth, change, and uncertainty. Before I hit that, joining me today is the newest member of our firm, Shawn McCabe. As you may have seen in our letter to you, our social media post, or if you've ventured to our website, Gunn and Company PA is now McCabe Gunn CPAs and Advisors. Shawn and I agreed to team up to better serve all of you, both today and long into the future. Considering we were Shawn's client for the last 4.5 years, we were able to experience his dedication to his clients, which paralleled exactly how we are dedicated to ours. Knowing that his passion for adding value to every engagement he's on made him a perfect match for our firm. Please welcome Shawn to the team. Most of y'all know me. I'm Marshall Gunn. I'm the founder of the firm. Been here, forever. And having a lot of fun and looking forward to a number of years still serving you and especially bringing these quarterly and today annual economic updates. I hope you learn a great deal. So let's reflect back. When we had our Q3 economic update, the election was over presentation just 3 short months ago, the US economy was continuing to slow. We had inflation declining but holding steady. The Feds were contemplating a possible rate cut or cuts. As we know, yesterday, they announced they have paused any additional rate cuts at this time. The economy is doing too well. They will continue to monitor the incoming data. We had unemployment continuing to hover at all-time lows. We were optimistic that the Fed rate adjustment would continue to result in a, quote, soft landing. Americans, though, continue to spend money on holiday gifts, fun with family and friends, travel, and entertainment, even if they are having to spend a lot more than they did last year. We had begun preparing for Trump 2.0. So what does all this mean? Well, let's take a look at current economic conditions and what the market has thought about this. Here are the major indices returns for 2024. As you can see, the S&P 500 was by far the winner, 29.57%. Wow. The NASDAQ, which is very tech heavy, of course, 25.2%, and the Dow 14.99. There are many factors that Shawn and I will review today, but basically, in spite of it being an election year, the market did very well. Of course, depending on how your portfolio has been allocated, your personal returns may vary greatly from the indices. Keep in mind, the indices are hypothetical, and the returns are not net of fees, nor do the returns include dividends. The tech-heavy NASDAQ and the S&P 500 have been the leaders, with the Dow advancing less than 2/3 as well. Bonds have lagged, as you would expect, but turned positive thanks to the interest rate cuts enacted by the FOMC, the Feds. But let's drill down on this a little bit. To further break down market performance, it helps to look at the S&P minus the impact from the top 7. This is a 2-year view, and as you see, while there have been positive returns, if you were not invested in the top 7, your returns were dramatically different. Let me emphasize, this is not a recommendation for buy or sell any specific security or securities. These charts are purely for informational purposes. Well, DeepSeek. This was not in our presentation a week ago. So how this will go and the direction continue is yet to be seen. But with a market emphasis on companies leading the development of artificial intelligence, it does warrant our attention. 2 major recent announcements include the Stargate project, a new U.S. company which intends to invest $500 billion over the next 4 years building AI infrastructure for AI in the U.S. Right behind that announcement was the announcement of DeepSeek, a Chinese AI company which develops open source large language models for artificial intelligence. It is owned and solely funded by a Chinese hedge fund, called High Flyer. Who had even heard about DeepSeek before Monday morning? Can I get a show of hands? Oh, we can't see. Well, as you can imagine, there's a lot of money in future technology creating a race to develop AI infrastructure. So stay tuned. We sure will. Shawn, help us out with the economic update side of things.
Thanks for that, Marshall. Great little review of what's going on in the markets. We were all kind of surprised by DeepSeek. Never underestimate the power of what a smart finance guy can do with $6 million to start a company. But so very interesting there. So one of the items I wanted to touch on today was the general economic conditions. Interest rates were all the talk and had the market on pins and needles at every turn last year. It's all we heard about. So what's in store for the economy for 2025? I know I'm asking that, Marshall's asking that, we're getting a lot of clients asking us that. But while rates are relatively low at the moment, and the trajectory of interest rates depends largely on two factors: policy, which right now is trade and immigration. We're hearing a lot about that, and inflation, aka what is the Trump administration going to do, and how will that impact the economy? Inflation, trade, and immigration. So we'll talk a little bit more on that in a little bit. We'll dive a little deeper there. What would cause the Fed to avoid more rate cuts or even increase the rates in 2025? And yes, it could happen, right? And the answer to that is a flare up in inflation. I agree right now with the Fed's posture. I call it cautiously optimistic. There's a lot of policy that could fluctuate, fundamentally shift the U.S. economy in the short run, and that would cause the Fed to adjust, maybe even overreact, some instances that we're used to in recent history. And that could be moving rates one way or another more substantially than currently slated. Which leads me to the next item on the slide: geopolitical and political tensions. Folks, brace yourselves. We may have some resolve in the Israel and Hamas conflict as the ceasefire continues and hostages are being freed, and talks of U.S. brokering a peace deal between Russia and Ukraine persist. I believe it's all far from over. While we may see some of the conflict quiet, there will be tensions in other areas. We're already starting to see it, namely China, Canada, Mexico. Yes, I'm referring to the proposed tariffs President Trump has on his agenda. Is he tearing pages from his book, Are the Deal? Or just negotiating to get what is needed? It's too early to tell. What we do know, though, is Trump is far from running wild with Congress as he has to work with. You see, there are now what Marshall and I are calling three parties. You have the Democratic Party, vehemently opposed to anything DJT, and then two sets of Republicans. You have the pro-Trump camp and those the not so pro-Trump camp. Saying all that to say, the dust hasn't quite settled yet on what's to come politically, but one thing is certain: there will be plenty to talk about as the year unfolds. A couple other bullet points that we'll address going through these slides. Corporate earnings remain strong, keeping unemployment at historically low and stable levels. And the consumer spending, as Marshall alluded to a few slides ago, keeping demand high. Unless any of the aforementioned issues bubble over, my crystal ball says we are poised for another good year. Keep in mind, I'm an eternal optimist, and for good reason, which I hope you'll see from the data in the next few slides. So Marshall said it a second ago. Chairman Jerome Powell said, we are headed for a soft landing. He said that back at the Jackson Hole Fed meeting in September last year. He indicated that we are headed for a soft landing as the labor market seemed to be cooling off and inflation was starting to give way, on course for the elusive 2%. I think the Fed has done a great job. In the past 4 months, the Fed has cut interest rates a full percentage point. Starting, the Fed funds rate is at 4.33 currently. Unemployment is less than 5%. Inflation is less than 3%, and the GDP is still positive. So the question remains, will we see 2% inflation as part of the soft landing, or will we have to course correct before then? It all depends on, can you guess? Policy. Everybody's waiting for that. So what I like about this chart, and I know we throw a lot of charts at everyone here, just to kind of illustrate the data, because no one really wants to pour into data and spend all day pouring through the numbers. I know there's some friends on this call that do, but I'm a simple person. I like illustrations. And the best way to kind of explain what this slide is how policy is affecting rates, right? And technically, the Fed should be politically separated and not involved with politics at all, and focusing strictly on the data and the numbers. But you got to think about the amount of dry powder they have to do what they need to do to hedge inflation and keep unemployment where it needs to be. So if you look at the blue dot, the light blue dots, that was where the Fed sentiment was on rates back in September of 24, where they thought the rates would be going into 25. Well, since then, you can look at the Fed sentiment since December of 24. And economically speaking, yes, we saw a little bump in inflation and some other things moving around, but the major thing in that period was the election. So now the Fed's target for lowering rates has increased. And why is that? Well, again, it's a dry powder thing. They want to make sure that wait and see, right? They want to see what the new administration does with policy and how that's going to impact trade and immigration, how that will curtail into inflation. And the Fed needs to have some ways to move. So you cut rates too soon, and all of a sudden those new policies come into place. Inflation starts going crazy. Then they have to rack the rates up super quick, super fast. And when that happens, it's not good for anybody. So I really do like the Fed's policy and where they're going right now. This chart is known as the Fed's dot plot and shows the Federal Open Market Committee, FOMC, participants' assessments on where they think rates should be measured by participants as the blue dots. So it kind of gives you an idea of the participants on that committee, where they think rates should be at a certain particular point in time, namely on the x-axis on the bottom. So the FOMC sentiment has us right around 4% for 2025. If you look at where we're at today, that's not a big move. So you're hearing on the news right now, the Fed's looking at maybe possibly, right? They were pretty quiet on it yesterday, saying they're leaving things the same right now, but the, maybe 25 basis points drops this year. We don't know. Which again, looking at their sentiment now and what they had with their Fed meeting this week, I think we're right about on point. Two cut plan for 2024. All right, so GDP, we got fresh numbers this morning. They updated, revised it to 2.8, but GDP continues to grow, albeit a little slower each quarter, with the most recent reading coming in again this morning at 2.8%. The Conference Board economic forecast for the U.S. economy forecast the U.S. to expand by 2.3% for 2025. So we're expecting to see GDP slow down a little bit more going through 2025. We'll see. So that's, again, we're in a wait and see right now. It's so early in the year in the new administration. But all in all, as Marshall said earlier, Americans are still spending. The Fed is doing what they can to keep inflation in check, and the economy keeps churning. I believe it's a great time to be invested in the U.S. economy. Speaking of economy, a little bit higher, kind of a broader view of where are we at? Where are we inside the economic cycle? As many of you know, the economy cycle. You have great periods of growth, and then you have some of those late periods where the growth isn't so good and growth is slowing. I believe that's where we are right now in the U.S., somewhere in that late, mid, or early late. You like that position as far as the economic cycle is concerned. And it appears if you look at China off to the left, a nice big red dot down there, they're in the early phase of recession recovery. But one thing I wanted to make a point about is countries, economies can stay in a position or even slide left and right. It's not 100% linear like this graph shows for a long period of time. So just because the U.S. is in mid to late cycle doesn't mean we can't stay there for again, a long period of time. The geopolitical unrest in the Middle East and Ukraine is not helping the situation, but hopefully we'll see some cooling off and some better economic times. Marshall's going to address some of that here in a few minutes. So you may be wondering, how does knowing where we are in the economic cycle really matter to me in my portfolio, or how I make investment decisions? Well, there's a relationship with economic cycle and investable sectors. Certain sectors tend to do better in different parts of the economic cycle. For instance, financials, real estate, consumer discretionary, technology, right? Big bold letters there. Industrials and materials all tend to do well during early cycle expansion. It's where the money's going. Think about it. Everything's booming. Money's pouring into tech, consumer discretionaries, real estate, financials. It makes sense. But take a look at energy, for instance, over in the third column. While the energy sector tends to do well during the late cycle, higher energy prices are often to blame for pushing economies into recession. Costs more to do business, costs more to ship goods. Every plastic thing we have has oil in it, right? So while in that instance, while correlation, meaning things combine together, move together, doesn't always mean causation, as it does for energy in this example, meaning higher energy prices could push the economy down into a recession or later into that phase of cycle. The best way to manage this, though, is to make sure your portfolio remains balanced and diversified to help minimize impacts from economic cycle adjustments, while also capitalizing when the times are good. Side note, please don't use this incredible knowledge to try and time the market, all right? Well-diversified portfolio. We're going to talk about that in a second. Again, just to touch on the inflation prints, 2024 inflation came in at 2.9%, ending 3 months of increases. I think that's what's also given the Fed a little bit of pause, even though they're reducing rates to kind of spin the economy up because they saw it coming. Inflation is going up, in a short period of time. So if you're still feeling it in the grocery store, prices haven't gone down, they just haven't increased as much. With that being said, we like showing the slide because I hear a lot from clients on, man, it's really expensive to live out there. Everyone keeps saying inflation's coming down, the Fed's slowing down on their policy just because they're still filling in the grocery store. And what I like about this chart, I'm gonna take a minute to explain this, is that this makes up what inflation is by spending category and the mix of where inflation has been coming from. So over the last couple of years, some of the biggest contributors to inflation have been energy, which is measured by the green bars on here. Food is the purple bars, core good is orange, and you can kind of see the other, but those three are the biggest categories as I see it right now. Whereas over the last 12 to 18 months, those items have tapered. And housing, which is the dark blue, and insurance, red, have been the main culprits of upward inflationary pressures. Even more recently, though, we've seen a reduction in costs for energy and core goods. If you look all the way over, we're above May of 24, you can see that orange and green are below zero, meaning we've had a reduction in those costs. So saying all that to say, the data confirms that we've all been feeling. Grocery prices spiked and stayed. We've all seen the increases on our insurance renewals. Lord help me. Amy and I have 3 teen drivers who are costing us crazy amounts of insurance, especially in Florida, where it's already expensive to have insurance. It's continuing to go up, right? And housing prices in some regions have as well. With the latest print of around 2.9%, inflation in general seems to be, air quote, under control, even though it may not seem so at the moment. A final note I like to make about this data is the increase in costs for dining and recreation. Marshall touched on that on his first slide here. A key takeaway with that is it's demand driven. If there's not demand, consumer discretionary spending, then these items would not be growing. To me, this is a positive indicator that the US consumer is alive and well for now.
Thank you, Shawn. Yeah, I get to talk about the international sector. This is always fun. Shawn alluded to it a little bit. I'll dogpile, if you will, on the Russia-NATO relations and the Russia-Ukraine and North Korea and Russia versus Ukraine. It's little. Sometimes it's hard to tell who the players are without a program, but that wages on, and we've got humanitarian issues we've got to be concerned about. There's been a lot of U.S. aid dollars filtering into the Ukraine to help support them. Huge question mark. Will that continue? There have been dollars floating into Israel. We've heard some very strange items appear in the last few days on what exactly were the items flying or being shipped into Israel and to Palestine. Um, we're seeing a continued release of hostages in that area. I think many of you are aware, the firm, especially in my case, we do have clients in Israel. I'm in contact with them on almost a weekly basis on needs that we can work with on them. It's just very interesting hearing their perspective of what goes on versus what the media gives us as a perspective of what goes on. But the new administration seems a little more pro-Israeli, but it will be interesting to see how things filter through Congress and what dollars end up into those conflicts. And can there be peace? Can there be a ceasefire and an opportunity for negotiations? U.S. and China, boy, that's a tenuous one right now. And I've got cyber attacks right below that, but obviously the TikTok transition is at the forefront of the press, at least, and the media. Chinese owned company, lots of American involvement, some questions about the security of the data being posted through TikTok and who owns that data. Made it all the way through the court system. And one of obviously the new administration's first steps was to, okay, let's slow down, let's take a look at it, give it a 75-day extension and see if something can't be worked out. There are a lot of Americans who make a good income by being involved in TikTok. So it is an enterprise within the US, but just some questions about the control on it. And if you ask me to predict where that's going to end up, it's 2 areas which I'm probably weakest in. One is predicting politicians, and number 2, understanding the drill down in technology. So what I can say is keep a close eye on that. Had a conversation with a new client just the other evening who's involved in cybersecurity. And of course, this is an area that just is geometrically multiplying by the need just to keep us safe. It seems like almost daily I pick up my phone and there's some phishing scam coming at us. We do a lot of effort to train to try and avoid these things, but we are all targets because there's a lot of money to be had and very little enforcement that can be done. So a lot of tension globally. I suspect that's going to continue through the remainder of this year and probably well into 2026. I do have a program for you. I mentioned it's hard to tell who the players are without a program, but it looks like I've been able to find this, and I really like this Venn diagram that shows us the three teams that are out there. We have a Western democracy who likes democracies and free market operations. We have the opponents of the Western democracies who like autocracies and state intervention in things. And then we have those that are non-aligned, kind of mixed political and economic regimes. They kind of side where they need to be at the moment. And of course, when you look at some of those economies, they don't quite even blip the radar screen. So where they may fall in line politically, they really don't have a lot of impact on economic activities, but they are players all the way around. So at least you have this, you know who's on our team. Local political tensions or domestic political contentions. Wow. We thought we'd have an election and everybody'd be happy and life would go on and we could really, know what's going to happen. Guess again, it's not the way it works. But U.S. debt continues to run rampant, unchecked. Probably like you, I was amazed at some of the political promises made by both presidential candidates. The last time I checked, other than having a printing press to print more money, the government doesn't manufacture or sell anything. The government earns money, if you will, via taxation. Might come from income taxes, might come from tariffs, might come from fees, comes recently from more debt, but it comes from us, the US citizens, the US taxpayers, either directly or indirectly. I always find it interesting when I hear the term, quote, fair share. My take is that my opinion of your fair share and your opinion of my fair share may vary greatly, but it makes for political fodder. So offering to not tax certain sources of income or give tax credit for certain activities means the money has to come from somewhere else. So the key that we have here, and here it is, folks, there's a spoiler alert, we're broke. We have 36 trillion with a T in debt and counting. For grins, if you ever get bored, don't do it right now, but write this down. If you go to US Debt Clock, that's USDEBT clock.org, you can watch how fast the debt ceiling is running. It'll probably nauseate you a little bit, but take a look at it. It's absolutely scary. The debt ceiling was suspended by the prior administration, by Congress to January 1st of 25, effectively kicking the can down the road to the new administration. Well, last week, the Treasury debt hit its $36 trillion limit, and the Treasury Department instituted what are called extraordinary measures to buy Congress time in raising the debt. Without the debt ceiling decision, of course, the U.S. might not be able to pay all of its debts by summer. So should this happen, the government would have to prioritize which bills it pays, potentially raising borrowing cost and shaking up markets. So prepare for more wailing and gnashing of teeth, market fluctuations, and a last-minute compromise filled with pork that kicks the can down the road. Wow, did that sound cynical enough? So I'd expect not much change there, especially while the US dollar remains the world's reserve currency. Best we can do is encourage our lawmakers to address it and wait and see. Shawn mentioned the House and Senate and what we are referring to internally as the three parties. We've seen a rash of executive orders. We've learned that from administration to administration, it seems like the first few weeks in office, it's how many executive orders can I do to outpace the previous administration. We've seen some new stance on DEI, diversity, equity, and inclusion. Many corporations have stepped up and said, okay, we're doing away with our DEI policies. We've seen corporations step up and say, hey, DEI is working for us. We're going to continue with it, but it will continue to be a hot topic as we move forward in the coming months. Political appointments. You know, we joke internally that if a political appointment gets 51% approval, it's a win. Obviously, the current administration's appointments are probably not popular with the last administration. The last administrations weren't popular with the prior administration. This is just part of what goes on as you have a new administration. Obviously, those appointments, while they make great media fodder, their impact on the market is generally pretty minimal. Again, as Shawn said, it's policy, not politics. And pardons. I still tried to figure out how someone being pardoned for a decade in reverse for something that they haven't been accused of or convicted of, but we find ourselves in this pardoning world, and I'm still trying to figure all that out. But there are people who will agree with the pardon. There are people who will disagree with the pardon. I'm just a layperson. I'm just trying to understand it. So maybe in time I will. Well, let me get back to the debt problem. Here's the deal. If you look on the left-hand side of the chart, it shows you where do we spend our money. And it's Social Security, Medicare, interest, defense, etc. Well, think what happens to interest when interest rates go up. So there is a real motive for the Fed to drop interest rates because then the US borrowing cost will drop as well. But to me, it's not a revenue problem. I see it as a spending problem. So let's look at we're spending it over there, and on the revenue side, on the right-hand side, where does the money come from? And you can see a big chunk of it comes from deficit projection, or that's a polite way of saying debt, or the credit card, whatever you would like. So while we heard political rhetoric ad nauseum regarding taxing and spending, the reality is there's very little that they can impact. The bulk of the budget is, quote, fixed, and there's no wiggle room. So virtually every politician can make promises they don't deliver on. This is why you need to consider the political feasibility associated with what they promise. They can try, but not succeed. Therefore, you really need to focus on the philosophy, the priorities, and the actual track records. Promises are cheap. Past results count the most. Well, hey, we got a new thing on the front, Doge. Now, there was the Doge coin out there, but this is a totally different. This is the Department of Energy Efficiency, Doge. And this was created by executive order on January 20th, 2025. It's scheduled to end July 4th, 2026, exactly 250-year birthday for the country. Doge has an office in the Eisenhower Executive Office Building, and it's going to have about 20 employees with teams embedded in different federal agencies. Well, what's the purpose? Well, the whole idea is to reduce wasteful spending, eliminate unnecessary regulations, and modernize federal technology and software. Just a sidebar on this, we deal with the Internal Revenue Service on roughly a daily basis, as I'm sure you would imagine. Did you know that we have to send documents to them via fax to communicate? They don't have email. And so it's telephone call and fax is the bulk of the way we transmit documents back and forth with the IRS. Okay, think about how you run your business and how your life. How many of you even have access to a fax machine? I'll leave that question right there. The leadership of the Doge Committee was to be led by Elon Musk, of course, the CEO of Tesla, SpaceX, and a few other companies, and Vivek Ramaswamy, a former presidential candidate, You're probably aware Ramaswamy has already resigned. So that was a quick in and quick out, but we understand he has continued political aspirations, is the story that we got. But the idea, of course, is reduce that government spending, reduce the regulatory burdens, get a smaller government that's more efficient and less bureaucratic. Let's hope for the best. They got a lot of work cut out for them. Of course, we don't know where all this is going to end up, but here we go. Shawn, been preaching to the choir. Help us out.
Yes, you've been preaching to the choir. It's kind of funny. Um, Trumponomics 2.0. It's kind of interesting. But I've got a question for you and the audience, Marshall. How much more confident do you think the Philadelphia Eagles would be if someone slipped them the Kansas City Chiefs playbook? I'd say they'd be pretty darn confident, wouldn't you? Now,
We're better than having Taylor Swift's song list for the Super Bowl.
right? Man, they would know exactly what to do. Now imagine the next step of that. Imagine these two teams played each other in last year's Super Bowl and made absolutely no changes to their playbooks. I imagine the Eagles would show up to this Super Bowl so confident the world would think they're arrogant. You know what I'm saying? I imagine most of you, Marshall, maybe even you too, because we didn't talk about this ahead of time, that you're catching on to where I'm going with this. And no, it's not about President Trump's, I'm air quoting, confidence, but you can't see me. It's about how President Trump told us back in 1987 precisely how he operates. In his book, The Art of the Deal, he hasn't changed anything, none of his tactics, which was evident back in his first presidency. And we're already seeing a lot of that in the current presidency. He's only been in office, what, 2 weeks? So saying that to say, love him or hate him, we know what we've got. He's going to leverage and seize opportunities. Think about Colombia, right? Hey, we're deporting your people back. Send planes. Oh, no, you don't want to? How about some tariffs? Guess who sent planes, right? Trump's going to squeeze for big deals and then negotiate the way he always has, and that's to use every tool at his disposal to secure the best possible outcome. Now, here's the caveat. Not really a caveat. Here's Shawn's demand of Mr. President Trump. As president, he should be acting and hopefully will be acting in the good of the nation with that kind of deal making. So I say all that to say, we now have an idea of what's coming down the pike, and we'll be all over it for you guys. The tax reform policy is going to be a huge thing that Trump puts back in place. You guys may remember it's called the Tax Cuts and Jobs Act of 2017. It's been a lot of talk the last couple of months as well, in our industry, of course. And it's one of the biggest things we're following. Congress and the new administration is either going to have to extend it or modify it. We already were pretty confident it was a campaign promise that they're not going to let it expire. We mentioned during our Q3 economic update that the presidential and congressional elections will be the first tell as to which way TCJA will fall. Well, the good news is it's highly probable many of the laws promulgated in TCJA will become permanent or modified, hopefully even better for businesses and the average American taxpayer. So I just wanted to go over again some of the items that are at stake with the Tax Cuts and Jobs Act. That if it did expire, which again we don't think it's going to, the individual tax brackets would increase from 37 to 39.6. Your alternative minimum tax becomes more likely because of the way the law changes. It will bring more items onto that schedule, so then you'd be more likely to be subject to alternative minimum tax. The state and local tax and mortgage deduction caps are scheduled to go back up, which the campaign promise of President Trump's was to either remove those or lift those anyway. Again, whether that's part of a 2.0 package or a new package altogether, we'll see. As the Tax Cuts and Jobs Act expiration would have the qualified business income deduction eliminated, as where small business owners get to take 20% deduction off their business income off their personal tax return. And the gift and estate tax exclusions would be cut essentially in half. So as we know more, we'll be reaching out to all of you to make sure you do as well. We're very attuned to all of our clients, whether you're on the tax side or on the financial planning side of our business. And we'll be getting in touch with you, let you know what to do. I'd also like to encourage you guys to follow us on LinkedIn and Facebook. We'll give you a QR code later in the slides today. We'll encourage all of you to break out your phones, scan that QR code, and you'll be given an option to all of our sources of communication, if you will. We're going to be posting regularly as things unfold and put out there that are important. But again, that's just in addition to our communication with all of you as we have been in the past. So won't change, just improving ways to communicate. So, or if you don't want to scan a QR code, just search for McCabe Gunn, you'll find us. So bringing it back to the data, let's talk a little bit about interest rates. The 10-year Treasury is yielding about 4.5%. The 30-year mortgages are about 6.75%. A critical driver of U.S. borrowing, as you know, is the 10-year Treasury, with the 10-year yield increasing from 4.1 to 4.5 since last quarter. Not too bad. We believe the driver of that is the economic uncertainty. No surprise, right? We are near record high home prices around the U.S., making it even more difficult for first-time home buyers to compete. According to some of our realtor clients, two main culprits here are rising interest rates and lack of supply. And I'm going to add into that, thinking about it earlier when I was looking at the inflation chart, insurance. Insurance is doubled. So it's also increasing the cost of home ownership. Interest rates have tripled since 21. Think about it. As you've all seen in the next slide, and existing owners aren't selling to hang on. Yeah, said differently, why would you sell your house if you got a 2.5% mortgage, which I do, I think Marshall does as well? We're going to hang on to those mortgages. It's almost free money. It's less than inflation. So people aren't selling their houses, and that's adding to a little bit of a supply shortage on the home pricing side. So just a quick visual of the 10-year yield. This is showing its low in 2020 and just for fun to say 0%. I like saying that. To the peak in October of 23 at just under 5%, with it floating. Again, it's about 4.5% today. And it's costing people twice as much to buy homes as it did in the past. And then the cost of financing is double and the insurance is double. So it's getting really expensive out there for the home pricing. The 30-year mortgage rates have increased over the last 6 months, increasing from just above 6% to about 6.75% today. Nothing too exciting there, just like putting things into a visual. Kind of giving you an idea, visual again on the existing home sales. This graphic simply illustrates the considerable drop in existing home sales to a level relative to 2008. As we were researching this data, I was looking across the dotted line at about 4 million, right? And we haven't seen lows like this, back in, before the 2000s, right? Since 2008. So it kind of made me go, it's kind of that 1-2 punch. Homes are more expensive than they were a few years ago, and mortgage costs twice as much as they did from 4 years ago. And I'm going to add that third one in there. Insurance rates are even higher. So those who have owned over the last 4 years, they're in really good positions. Probably a ton of equity in their homes, great rates, and most likely more increase in value will continue. So why move? Why sell? So the existing homes available for sale, I think, are going to struggle for a little while until builders catch up. So Marshall, I'll turn it back to you. Let's discuss a little bit about that labor market.
Sounds good, Shawn. From a help wanted standpoint, everything seems to be holding steady. We touch base on that. Keep in mind, target is below 5%. The consumer confidence is up from where we were during the summertime. We're right back where we were in March, but it's down for the year. So we're not quite where we were in December. So why is this happening? Well, consumers have jobs, they have money. Again, as I mentioned earlier, not as much as they once had, but they are spending. The barrage of campaign ads reminding everyone that the economy is bad, so elect me, is the narrative, and Americans were believing it, despite the data pouring in saying just the opposite. The finality of the election was a huge driver for the increase. It wasn't a case of which candidate won. It's a case that I don't have two candidates telling me things are terrible. This apprehension still hasn't kept Americans from reaching for the credit cards. They're spending their last cash reserves, increasing debt on traveling and enjoying their YOLO. You only live once. A tidbit, according to Bankrate, about 48% of credit card holders now carry a balance from month to month. Wow, that can be 23%, can be even worse. Now that's up from 44% at the beginning of 2024. Let's look at the other indicators, leading economic indicators. Well, they continued to decline from where we were a year ago. But again, we saw a little bit of a bump, a little bit of improvement from where we were in September. I call that the post-election euphoria. We're seeing those things because people relaxed a little bit after the uncertainty. You had 51%, I guess, of the population that was the outcome went their way. 49% it didn't go their way. So I guess we're getting that minor blip that 2 point spread is what's driving the leading economic indicators up a little bit. What we really need to look at is investing in economic in uncertain times. I use this one every single presentation. My apologies. I love this slide, but I'm always hopeful there will be a certain economic time one day. So here we go, and we will see that, well, things haven't changed. We're still embedded in a bull market that continues, and we're due for a correction. Haven't had a 10% or more correction, but less than 20% in a while. We're not hopeful for a bear market. We saw one of those back, a couple of years back. At the moment, the economy has a lot of things going for it. One of the things that it has going for it is cash. I realize this is a horribly busy slide, and basically this it's from the SEC. So anything we get from the SEC can look a little crazy. But what these dollar amounts represent are investments in money market funds, which are now approximating $7 trillion. And the different colors are the different brokerage houses. I'll pick on Fidelity. Fidelity's the big orange one at the very bottom because we do a lot of work with Fidelity. And as you can see, the money market funds, or what I call the money sitting on the sidelines, continues to grow. Keep in mind, a few short months ago, we were getting better than 5% on our money market holdings, and things were nice. Today, that number is well below 5% and falling every time the feds make rate cuts. So we're sitting there on one hand going, wow, we want the Fed to go ahead and cut rates. We want the economy to remain strong. We want a soft landing. But wait a minute, if they cut rates, my money market income is going to go down. I don't want my money market income to go down. Somewhere in there is the balance. We know that some of this money will ultimately end up in the market as investors seek higher yield to combat inflation. Keep in mind, 4% income in a 25% tax bracket and 3% inflation means you made nothing on your money for that time you had it tied up. Well, here's another one of my favorite charts, diversity. I am such a proponent of diversity in portfolios, and I apologize for the busyness of this slide, but there are lots of options to invest your money in, and each one of those asset classes has merit. However, as we've learned, this year's winner may be next year's loser. Notice how commodities, the light green in there, had generally been in the lower couple of boxes almost every year. But look what happened in 2022. Well, think about it. Commodities are an inflation-sensitive investment, so when inflation goes up, commodities do well. Now, fast forward to 23, inflation dropped, commodities stunk. So it really is that there are variables that impact each of these asset sectors. Now, generally, the large cap stocks, the darker green, remain in the upper areas. And look how REITs, the dark blue, went from the seller in 2020 to the darling in 2021. Wow, that can happen to you in a heartbeat. Very interesting. And then look what happens in 2022. Back to the seller again. The key is to keep a diversified portfolio that meets your risk tolerance and goals. Notice how an asset allocated portfolio, the white boxes, generally have been good returns almost every year. But keep in mind there are three basic investment opportunities. One, currency denominated. Treasuries, CDs, money market funds, they generally give you a return, an interest rate, but you might lose purchasing power that you had when you started to an extent greater than that return because of inflation, and especially after inflation and taxes, the example I used about the 4% return a minute ago. There are commodity-based investments like gold, silver, and most recently Bitcoin. These give you no return, You're investing with the hope that someone else will believe it's worth more than you paid for it. There's no tangible formula to support its price. So investors rudely refer to this as, quote, a bigger sucker investment. Somebody will pay me more for this thing which really does nothing. And then there are earnings based investment, stocks, income producing real estate, farms, and businesses. These produce a return that the earnings can be quantified. And if the earnings are quantified, the value can be imputed from the earnings, price earning ratios, and earnings per share. But Shawn, as we all know, it's different this time. So help us out.
It may feel different this time, and I can't tell you how often I've heard that, especially with the different presidencies and whatnot. But it's different this time, right? Well, no, it's not. It's not different this time, and it will not be different this time, and it won't be different next time. The only thing constant is change, right? So the fluctuations of the markets are here. They're going to stay here. And I want to start by saying, Marshall, you opened this section discussing, investing in uncertain times, right? And right now it feels uncertain. We've said it a lot today in our presentation, like wait and see, wait and see, wait and see. The Fed's saying wait and see, right? We're going to move rates depending on what happens with the administration. It's fluid, it's moving, right? And for 2024, we saw very little reason not to buy stocks. But during periods of downtimes, it was either the election, union strikes, the Fed policy, what's going on in Ukraine, China, tariff. Well, no tariffs yet, but my point, the election. And I know we cover this slide often, but we all need to remember this slide when the next sell-off hits, because it will, right? And it's going to feel different this time. I remember back in 2000 and in 2008, frankly, more so 2008 for me, because I was actually in the business working as a financial advisor at one of the big broker dealers. And, everyone would come into the office going, literally, it's different this time, Shawn. We've got to get out. We've never seen a global financial crisis like this before. We have, yeah, it was back in the 30s. So maybe we forgot about that. Okay, you weren't allowed to feel that. Okay, I understand it. And it's different this time. Well, it wasn't. It was a temporary setback. The market rebounded over the last since 2008 to 2000 now. If you looked at the returns, and I'm going from memory here, so don't hold me to this completely, but I think the Dow touched somewhere around 4,666. I think I got that close, Marshall. And where's the Dow today? All right. So if you just ignored a lot of that fervor, if you will, on those years that it's different this time, and rely on the resilience and ingenuity and drive of the American entrepreneur and the American corporation that's driven to make profits, that's good for us from an investment standpoint, those ingenuity and resilience items will outlast any temporary market fluctuations. It has for the last century. So have confidence in this. Have confidence in your financial plan. Have confidence in us as your advisor as we're going through and doing our best to process all this data for you guys and for ourselves and understand what's going on in the world. That's more just to let us know where we're at and help understand what the media is saying about all these things and how that drives down into your portfolio. It always boils down to this, right? Things you should be doing with your financial plan. Number one is if you haven't done this exercise with us, I'd encourage you to do so. I know there's an equal amount of existing clients, but also potential clients on the call or people just checking us out. But if your advisor hasn't sat down with you to help you achieve or look at achieving or protecting financial independence, then what are you investing for? I always ask that question. Getting into your overall financial plan. That the investment decisions you make should be for a reason, for a financial reason, not just to make money. Money's the scorecard. And part of me talking about protecting your financial plan is getting in the risk management and insurance of things. If you own a business, looking at protecting that, your personal assets, your personal financial plan, husband and wife, if you're pulling each other's income in to plan for that financial independence in the future, make sure that you have those insurances in place to cover if one spouse passes away or becomes disabled or even gets put in a long-term care facility. You can plug those holes in the financial plan through insurance, education planning, retirement planning, all those things that if you don't plan for it, and they're kind of easy to plan for, you just have to take the time to do it. And that's what Marshall and I and our folks are here for, is to say, all right, let's set this portion aside for here, this portion aside for there. And the investing, as you can see on this chart, it comes at the bottom. It's the last part of this. We got to know where you're going. You should know where you're going. You should have a good, solid financial plan in place to not only overcome all the reasons not to invest on that last slide, but to make sure you're investing with a purpose. Then you can formulate your portfolio, put your investments to work, and rock and roll. And then some really cool items that we love helping with is minimizing taxes. Obviously, we're always looking to do that with the caveat you never let the tax tail wag the dog. And then most importantly, in the financial planning realm is estate planning. A lot of people don't take estate planning seriously. I know Marshall and I have both had situations where we have clients who did not do their estate planning proficiently or efficiently, and it creates absolute havoc for those left behind. Not only that, it decimates the value in wealth transfer that you get to give to your heirs. So a little bit of planning, a little bit of cost up front goes an absolute long way. So I'll wrap it up by saying a lot of what we talked about today is fun. It's great to look at. It's what the media is looking at, but in reality, it doesn't matter. What matters is two things: your financial plan and all things that go into that, and building a portfolio with investments you know and understand. And back to Marshall's Callan periodic table, it shows a little box. Having a well-diversified and allocated portfolio that will give you a return that you can plan on. So if you don't feel that you're in that position, that'd be a good time. Let us know. Reach out to us. For our clients, you should already be there. But that's where I'll leave it for now, Marshall. Anything to add to that?
What I want to do next, of course, is address some questions. And oh, let me point out now that I have this up, the scan of the QR code. If you want to take your phone out, I'll leave that up for a few minutes while Shawn and I answer some questions. If you have any, please feel free to type them in the chat box. I had a couple of comments drop in so far, and but we do have some questions. So Shawn, I'm going to ask you to field a couple of these. Um, you touched on it a little bit in the Tax and Jobs Act. Um, what do you think on the estate tax exemption? Are we going to go down to 3 million, 1 million? You got a number you throw out there?
I would say I would expect the estate tax exemptions to stay where they are, maybe even inflate for inflation. Again, that's a wild guess. Don't hold me to that. We're in a definitely wait and see right now with Congress and what they're going to do. But based on campaign promises, based on the TCAJ being implemented during the last Trump administration, I would expect the estate tax exclusion to remain steady, if not inflate, or adjust for inflation. And those of you thinking about, oh no, if the estate tax exemption gets cut in half, that's still 13 million for a married couple, if I'm not mistaken, give or take a few dollars there. And then 7.5 million or 6.5 million for an individual. You're starting to get close to where, okay, a lot of people may need to do some updating their estate plans. But again, if I wouldn't make any decisions until summertime. I think by then we'll know a little bit more of where we're going. Worst case scenario, please don't run out and go change your plans. You might have to put a pin in this until November and get it done before the end of the year if nothing's going to get pushed through. It wouldn't surprise me if this can wasn't kicked down that long because there's a lot to unpack with the Tax Cuts and Jobs Act renewal. But stay tuned. We'll be on that. Don't make any decisions yet. I do expect it to stay high.
All right. Next one we had come in was a stock market forecast, a Federal Reserve forecast for 25 and beyond, and are we in a buy or sell stock market for Q1 of 2025? Well, I think we talked a little bit about the Fed outlook, showed you what they are saying they're looking to do. The stock market forecast, I'm going to go on a bold statement and say it probably won't be as good as it was the last 2 years because let's face it, they were phenomenal, especially if you were in those top 7 companies. And as well on that, are we in a buy or a sell? Keep in mind, every time someone buys a share of stock, someone is selling that share of stock. So it's an equal world. But I will put this out there. When it comes to the market, you must be present to win. So if you're not invested, I can assure you, you will not have any positive or negative returns. It just depends on what you're going to do with the money. So historically, we can look back, but we know past performance is no guarantee of future returns. See how that just kind of rolls off my tongue? I've been saying that now for too many decades. But you must be in it to win it. You've got to look at solid companies. You have to build portfolios that are based on profits, dividends, and solid investments, solid things that the economy likes regardless of the economy. So always build your investment portfolio with companies whose profits are not tied to politics. And that way we know, regardless of what happened in the White House, people are going to continue using the Charmin, taking their drugs, and using their cell phone. So be sure to scan the code above, follow us on social media, and you'll be linked to all of the resources we have to try and keep disseminating data to you on a timely basis. First off, thank you so much for being with us today. So glad to have you as part of the team. I'm sure our attendees appreciate the insight and knowledge you're sharing with them. To those attending today, if you know someone who'd benefit from our webinar, we'll be offering a recording of today's presentation on the McCabe Gunn YouTube channel. Once it's posted, we will email you a link. So if you have a friend or family member who registered but wasn't able to tune in this morning, they will get a link to that site. Feel free to share it with family and friends. Our next scheduled event will be the Q1 Economic Update. That'll be held on Thursday, April the 24th at 10 a.m. Be watching your email for the invitation. We'll be getting that out to you in the coming weeks. Should Congress pass any meaningful, that's loaded gun right there, any meaningful tax law in the interim, we will hold a special presentation to keep you informed. That's our thing. We want to keep you up to date. So watch your email for any details. Thank you so much for joining us. We look forward to meeting with you soon, and I'm sure we'll be talking to many of you in the coming months for tax season. Take care and stay safe.